What's up, everyone? Dylan here. I wanted to hop on for another episode of the weekly analysis video. The last week has been very chaotic with all of the geopolitical tensions. I have been very active trading the commodities market, and again, I've been putting a ton of hours into being at my desk, and it's just been all over the place. So it's been good, don't get me wrong, but I've been very busy in terms of trading for the firm and just trying to digest all of the information that is being thrown at me. And so the purpose of this video is to hopefully be able to explain very simply how all of these geopolitical tensions affect the United States stock market and what to look out for going forward. So with that said, we'll hop right into it. So if you go back exactly a month ago, literally 1 month ago on May 19th, right? We were right here where I drew this vertical line, okay? Since then, the direction of the stock market has been very lackluster, okay? So there have been some fluctuations since then, but ultimately it's been pretty much going sideways where as of this moment, the S&P is very close to where we were exactly 1 month ago, okay? So what matters going forward? So usually, historically speaking, wars are not very bearish for the market. Usually, in the past, anytime a war breaks out, you'll get that initial spike of volatility, right, where the VIX goes up in value. As a result, that puts pressure on the S&P and the NASDAQ, and usually it is a good it has worked very well and effective to buy that initial dip from those initial headlines that a war is starting, because it has been proven that that initial dip is usually bought and then the market ends up going higher, okay? And so far, that has kind of worked. But going forward, the biggest threat to the equity market is the rise in oil prices, okay? Very simply put. So there is something called the Strait of Hormuz, okay? This is what the Strait of Hormuz is. It basically is right in the middle of Iran, and then it separates basically Iran to UAE, Oman, Saudi Arabia, and Iraq. What is the Strait of Hormuz and why is it important? The Strait of Hormuz is the world's most critical oil transport choke point, right? About 20 million barrels of oil per day, which makes up nearly a third of global seaborne oil, passes through this narrow waterway, making it vital for global energy markets. Iran has repeatedly threatened to block the Strait of Hormuz as a retaliatory measure against internal pressure or military action. Such a move would drastically disrupt the global oil supply, which would spike prices and likely provoke a strong international response. Okay, so the reason the equity market has been pretty lackluster in direction is because a lot of investors don't really know what to expect, okay? Will Iran retaliate and block the strait, or will they not go to that distance, right, that caliber, and will they just continue to try to defend Israel's attacks and maybe strike back and kind of go back and forth with that, right? So the answer is no one knows. I mean, maybe there are people out there that are involved in the military that know, but in plain English, I don't know, and the vast majority of investors don't know, okay? What do I think, right? If I had to really guess, I don't think that Iran will do that because they simply don't have the resources to defend themselves at this point. Okay, so they don't have the means to protect themselves, right? So, in my opinion, it would be foolish for them to retaliate because in the last week, a lot of their resources have been stripped away. There have been cyber attacks on their banks. Their military operations have been destroyed, with top officials and layer officials dying, right, being killed in the strikes, right? Weapon manufacturers have been getting destroyed. The equipment have been getting destroyed. Nuclear scientists have been getting killed, right? So a lot of Iran's nuclear facilities have also been destroyed. So again, I don't think they have the means to protect themselves if they go that extra step and retaliate and block the strait, because US has been very, very vocal, especially Donald Trump, that if they do go ahead and block that oil transport checkpoint, which is choke point, my fault, right? AKA the Strait of Hormuz. Trump has been very, very vocal in terms of the fact that U.S. will step in and absolutely crush Iran and what it has left, per se. So I think that it would be a suicide mission if Iran decides to do so. Okay, so what are we looking at in terms of oil, right? Let's go to the commodities, right? So crude oil has rallied higher on since the war originally broke out, right? So the war originally broke out, right, where the initial headlines started to come out right over here. So since then, right, oil is up about 9%, and at one point was up as much as 15%. Since those initial headlines were coming out when Israel, did the strikes on Iran last Thursday night. Okay, so there is a chance that if Iran decides to retaliate and block the strait, that crude oil can continue to the upside and really, really, really explode in plain English. So that would look, I would not doubt, if that were to occur, I would not doubt to see oil right around this 90 handle, which it hasn't been at since October of 2023. So you could see, based on this trend line, that it has been rejecting this trend line that it was established back in September of 2023. Okay, on top of that, you also have USO, which is the equity for United States Oil Fund. This is directly correlated to crude oil futures. You have USO that is being rejected at this key critical trend line, or horizontal resistance line that has been very, very key resistance since September of 2023. Plus, you have massive volume as well. So usually, not always, but usually, when you have a massive spike in volume, either after a large uptrend or a large downtrend, that tends to mark the capitulated top or bottom, where it starts to initiate a new trend. In this case, it would be a trend lower. Does it always work like that? No, but that's just the general rule of thumb. So what I'm basically saying is that Brent and crude oil are at a very, very key inflection point, right? This is Brent as well. You could see very, very similar to crude oil. Brent and crude oil have both tested a key area of resistance, which lines up with USO also hitting resistance as well. So those lines going forward remain very, very, very important, okay? Because if crude oil does explode to the upside, right, if Iran decides to retaliate and really, really take this war to the next level, right, what would that do? That would lead to higher inflation, right? A rise in oil prices tends to lead to higher inflation, making the Federal Reserve, right, Powell, more cautious about lowering interest rates. And what has Trump been vocal about all year? He's been really, really pressing Powell to lower interest rates. So the threat of higher oil prices puts Powell in between a rock and a hard place, because he'll be even more cautious about lowering interest rates, which will make Trump frustrated and not happy, which puts more pressure on the stock market. Okay, so hopefully you guys understand that relationship, why one affects the next, and then so on and so forth. So it's a chain reaction. Iran retaliates, crude oil goes up in value, the Fed becomes more cautious about lowering interest rates, and as a result, it puts more pressure on the US stock market. Okay, so again, hopefully that makes sense. So going into technical analysis on the S&P and the NASDAQ, there's a very, very important wedge pattern. And right before I started making this video, the NASDAQ actually retested that wedge pattern, right? We got to go like that. Let me redraw that. So let's see. So there's this wedge pattern on the S&P, right? The S&P had bounced at that line that was established in late May, right? Broke below that trend line and then retested the trend line, okay? So going forward, this trend line remains very, very important, and it sits, at the time of me making this, it sits right at 6,037. In terms of NASDAQ, very, very similar, but again, NASDAQ has already retested and failed at that trend line. So you can see, let's see, I'll go to a 1 hour chart. So very, very similar. This trend line also started on May 23rd. You can see 1, 2, 3, 4 different tests. Right, I'll go down to a 30-minute, and you can see very recently in the last hour, NASDAQ came right up to that trend line that was previously deemed as support and turned into resistance. So similar to S&P, right, the NASDAQ trend line remains very, very important to keep an eye on going forward. Ideally, the bulls want to see a recapture above both trend lines and the ability to sustain value above there. Okay, that would be a relief to sentiment. Okay, what would help that is if crude oil continues to the downside. If crude oil comes off, that will take pressure off of the S&P, and ideally, or it should allow the S&P to rally because of that pressure being taken off. Now, there's other factors that influence the S&P and the NASDAQ, but that would certainly be a good relief for the equity market, okay? Because it would show de-escalation in tensions, and crude oil would go down, which would essentially allow for inflation to also go to the downside as well, okay? If that area gets rejected going forward, right, on S&P and the NASDAQ, right, where sellers continue to defend retest into that trend line, the next level down would be S&P 200-day moving average. Okay, the 200-day moving average sits at 5,961 at the time of me making this video. Okay, so it got pretty close earlier today, but it did not quite get down there. So, okay, so going forward, if that trend line continues to reject, and bears continue to keep a lid on prices each time it tries to rally, that 200-day moving average on the S&P 500 futures remains key going forward, okay? And then beyond that would be this SPY level, right? If we go to SPY, where are you? Right here. This SPY level remains very, very important to the downside if the 200 moving average does not get defended by the bulls on the S&P 500 futures. The next level down would be this trend line that sits right at 590 or 589 on SPY. Okay, so going into tomorrow, we have OPEX. Right, I posted this today to the Academy chat. You could see Goldman Sachs, John Marshall estimates that just about $6 trillion of notional options exposure will expire this Friday, which is tomorrow, including $4 trillion worth of SPX options and blah, blah, blah. Okay, so there's some color right here. So there's a lot of moving parts heading into tomorrow, and the order book could potentially still be very, very thin because today was Juneteenth holiday, which the equity market was closed today. Globex was still open, so the S&P futures and the Nasdaq futures were still open with shortened holiday hours. But usually after a holiday in the equity market, the subsequent day is pretty thin when it comes to the order book and volume. So with OPEX tomorrow and overhanging geopolitical tensions, it could get very, very volatile. Okay, so that's something to look out for going into tomorrow. And hopefully I will speak to you guys soon. But hopefully this video allowed you guys to understand the direct effect of geopolitical tensions and how they affect the overall U.S. stock market and kind of what to look out for going forward, what really, really matters in terms of the influential aspect of the risk that it poses to the equity market. All right, so that's it for me. If you guys like this video, feedback is always appreciated. And if you guys have any questions, feel free to comment below. Peace.